Good morning, ladies and gentlemen, and welcome to the Shriram Transport Finance Q2 FY2022-2023 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Umesh Revankar, Vice Chairman and Managing Director. Thank you, and over to you, sir.
Yeah, thank you. Good morning, friends from India and Asia. A warm welcome to all of you who joined this call. Good evening to those who joined the call from the western part of the world. Today we have our joint managing directors, Mr. Sudarshan, Shriram, Nilesh, Sundar and Parag, along with me, and Mr. Sanjay, who is our IR head. In the first quarter of this financial year, the Indian economy grew by 13.5%, the fastest in the last 4 quarters, on account of better performance by agri and the services sector. The official data showed India remained fastest growing major economy in April to June quarter. However, it fell short of the expected 16.2% increase anticipated. The IMF in the latest World Economy Outlook report cut its forecast for India's gross GDP growth in financial year 22-23 by 60 basis points to 6.8%, warning of a long and tough economic winter. India's headline inflation rates as measured by CPI rose to a 5-month high of 7.41% in the month of September from 7% in August. This is the 9th consecutive time CPI print has come above RBI's upper margin. The stubborn inflation is definitely having some adverse effect on consumption, and there are some indication of economy slowing down. However, I attribute this to unexpected rains or unscheduled rainfalls that got delayed in the month of June, July, and there was late rains in certain pockets that disturbed agri movement and that would have led to food-related inflation. However, the wholesale inflation eased to 10.7 in September as against 12.41 in the month of August. The WPI in September was 11.8. Despite easing wholesale inflation data, the WPI continues to remain double-digit for 18th consecutive month, beginning from April 2021. The RBI, in its monetary policy on September 30th, 22, has hiked the repo rate by 50 basis points to 5.9%, fourth straight increase in current cycle, to tame sustained above target retail inflation rate. The RBI now has rates by total of 190 basis points since its first unscheduled meeting hike in May. The economic growth projection for 23 cut to 7% from 7.2 estimated in August, and GDP is expected to grow 6.3 in September quarter, 4.6 in December and March quarters. The inflation projection retained at 6.7 for ongoing fiscal year, and inflation to remain above the tolerance limit of 6% of RBI. The GST collection seems to be doing well. India's tax collection from sales GST was 1.47 trillion in September, as against 1.43 trillion collected in August. On account of rising demand, higher rates and greater tax compliance, this is second highest collection next to April 22 collection of 1.67 trillion. The goods and service GST collection remained above 1.4 trillion for 7 straight months during this month, continuing to display very high buoyancy. This augurs well for government spend on infrastructure. The government has announced national logistic policy aiming to achieve quick last mile delivery to end transport-related challenges. The policy focuses on key areas such as process reengineering, digitization, multimodal transport. It is crucial move as high logistics costs impact competitiveness of domestic goods in the international market. Along with PM Gati Shakti, which is a national master plan for multimodal connectivity and part of NIP of spend of USD 1.35 trillion target, with a vision to develop technologically enabled, integrated, cost-efficient, resilient, sustainable, trusted logistic ecosystem in the country for accelerated and inclusive growth. This is highly positive for the transportation and logistic industry and to our business. The monsoon has, as I was telling you in the beginning, there was some disturbed monsoon in the northern part, especially in the UP, Bihar and MP. But overall, the acreage was little lesser than the last year by 5%. Apart from paddy, there is a slight difference in sowing of pulses, oilseeds, jute. So overall, the drop is very insignificant. However, the late rains and the reservoir being full augurs well and for bumper crops in Rabi, which is always a much bigger crop across India, and Rabi being bumper and year on year for last 4 years augurs well for rural and semi-urban economy. Coming to the auto industry, the commercial vehicle sales is increased by 39.48% to 231,880 units in Q2 as against 166,251 units in Q2. And compared to the previous quarter, it is 3.37 increase. The heavy and medium commercial vehicles showed maximum growth with 48.93%, with 79,650 units sales against 53,481 units. Significant portion of this heavy commercial vehicles are the dumpers and tippers, which the demand is coming from the infrastructure industry. LCV numbers also showed good growth of 35% to 1,52,230 units compared to 1,12,770 units sold in Q2 last year. Tractor sales have been almost on par with last year's half-year number, with 3,19,642 number against 3,15,250 numbers, a marginal increase. The earth-moving and construction equipment showed significant growth again for the first half of this year, with 42,530 units being sold against 32,398 units. Coming to the company's performance, the collections were consistently good. The average collection of September quarter were 100.13% of the total demand, as against 99.03% of the corresponding quarter last year, and 101.45% in the Q1 of the previous year. We clocked a disbursement growth of 19.51% to 17,769 crores against 14,868 crores in the same period of previous year, as against 16,670 crores in the Q1 of this year. The used vehicle disbursement increased by 15.27% to 16,502 crores as against 14,313 crores in the same period of previous year, as against 15,754 crores. The new vehicle disbursement has improved significantly. It has gone up by 106% to 1,020 crores as against 493 crores in the same period previous year, and as against 784 crores in the Q1 of this financial year. Overall, the AUM, asset under management, grew by 11.18, on line with the guidance of 12%, to 1,35,249 crores as compared to 121,646 crores in the previous year, and increased by 3.49 against the previous quarter of 1,30,688 crores. The net interest income increased by 22.85% to 2,693.96 crores against 2,192.82 crores in the same period previous year, and marginal increase of 2,641.74 crores against the previous quarter. The net interest margin improved to 6.98 against 6.44 in the same period previous year, and 6.91 of the previous quarter. The PAT increased by 38.33% to 1,066.87 crores in Q2 compared to 771.24 crores in the Q2 of previous year, and against 965.27 crores in the previous quarter. The EPS stood at 39.44 against 28.71 in the quarter, this quarter. The gross stage 3 declined by 7 basis points to 6.93 against 7.82 in the previous year and 7% in the previous quarter. The net stage 3 stood at 3.48 compared to 4.18 in the Q2 previous year and 3.52 in the Q1 this year. The credit cost for the current quarter stood at 1.67 against the 2.68 of full year. The cost to income ratio marginally increased to 31.12 in this quarter against 20.73 recorded in the same period of previous year. The update on the merger, we have received approval from all the regulators like NSE, BSE, RBI. Then NCLT had convened the shareholders and secured creditors, unsecured creditors meeting, the IRDA, CCA. The final order of the NCLT was heard on 19th of this month, October, and we expect the order in a week's time. The growth outlook remained at the original guidance, 15% for the combined entity. Now I request our CFO, Mr. Parag Sharma, to take over the call and give details on liability side.
Yeah, hello everyone. The fund mobilization for Q2 was good. Liquidity continues to be good across banks, and that has been the focus area for fundraising. Some fundraising increase has been there from the capital market in the form of bonds also. Overall, for Q2, we have mobilized 17,000 crore, the gross mobilization. Total debt outstanding as of September is 1,25,586 crores. The cost being marginally up compared to Q1 by 10 basis points. But if you look at year-on-year basis, it is down by 16 basis points. Liquidity continues, on balance sheet liquidity also continues to be strong. We have liquidity of close to around 20,700 crores. Liabilities for next 3 months is only 13,000, so there will be sufficient cushion for managing our liabilities for next 6 months also. When it comes to ALM, each bucket, as in past, continues to be positive. Cumulative automatically is positive. Leverage ratio is at around 4.51, with excess liquidity being utilized. Leverage ratio should slightly drop below 4.5. HQLA is at 188% versus 191 in the previous quarter. We did announce buyback of our offshore bonds in August, and we did buyback close to around 256 million of bonds, which were maturing in 2025 and some part in October 22, which was a maturity for a short period. That was bought back, and currently we have announced buyback of our July 23 bond with a cap of 250 million. That process is on. Will take another few days to realize how much interest is there. Incremental cost of borrowing is definitely up by around 50 to 70 basis points. So we do expect the overall cost of liabilities to go up in next quarter. We have increased our FD rates also in the shorter duration by around 25 basis points, in the 3 to 5 year bracket by 5 basis points. So now I move on, give it to Sundar.
Thanks, Parag. Hi, everyone. The employee count has increased in the current quarter by 1,056 employees. As against 25,720 employees in June quarter, we are currently having 26,776 employees as on 30th September. The cost to income has marginally increased in the current quarter to 21.12. That is primarily due to a one-time hit of 65 crores because of the settlement of certain sales tax litigations in which the company had opted for the amnesty schemes. And in the one-time restructuring which RBI had permitted last year, the outstanding as on 30th September was 683 crores. Here I would just like to mention that in the investor deck that we had circulated yesterday, it was wrongly mentioned as 6830 crores instead of millions. And the coverage ratio was 51.57% as against 51.62%. And stage 3 improved to 83.29% as against 82.49% in the previous quarter. And stage 2 was 9.78% as against 10.51% in the previous quarter. We maintained a coverage ratio of 3.29% as against 3.21% in these for stage 1 assets, and coverage ratio of 8.84% as against 9.18% in the stage 2 assets. The PD was 7.35% as against the previous quarter of 7.34% in the stage 1 and 21.62% as against 21.75% in the stage 2. And the LGD was 44.75% as against 43.76%. And the capital adequacy was strong at 22.48%. And Tier 1 was 20.59% and Tier 2 was 1.89%. And we continue to have the COVID-related overlay of 1,741 crores as against close to 1,830 crores in the previous quarter. That's it from me. I will like to open the floor for the questions. Thanks.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. An operator will take your name and announce your turn in the question queue. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants may press star and 1 to ask a question. The first question is from the line of Rikin Shah from Credit Suisse. Please go ahead.
Hi, good morning everyone, and thanks for the opportunity. I have 4 questions. First one was on the new vehicle disbursement and the AUM growth. So the new vehicle AUM has grown after 14-15 quarters. So just wanted to get a sense on the outlook from here for the new vehicle AUM. Second one was relating to the margins. Have you taken any rate hikes on the loans for any products, and what would be the quantum of the same? And on the liability side, could you please recap the total bond buyback that you did in 2Q and are looking to do in the 3Q? And thirdly, on the OpEx, I think you did mention that there was certain one-off of 65 crore. Could you please elaborate on that, and whether do we see that repeating in the coming quarters? And lastly, there were news flows pertaining to Shriram Group looking to lead the consortium in buying the IDBI Bank stake. So just wanted to get a sense on the rationale of the same and or the strategy out there. Thanks. That's all from my end.
Yeah. Thank you, Ricky. See, new vehicle, if you see quarter on quarter, our lending is going up because our customers, typically what we do is we lend to our existing customer who are already a used vehicle. When they wish to upgrade, then we fund them. We don't have a direct arrangement with any OEM or a dealer point for lending to the new vehicle business directly to new customer. So as the economy progresses, when our customer decides to buy a new vehicle, then he upgrades himself. So to the extent we are increasing the new vehicle portion. So last quarter we did around 1,000 crores, and we expect that to grow. It may not have a significant increase on the overall AUM immediately, because since we have not done new vehicle lending for last 3 years much, so the AUM is actually coming down, and with new lending it may get stabilized and then move up. So overall proportionate, it may not make any difference between new and used. So margin-wise, we are whatever the net interest margin of around 7% target, we may be plus or minus 10 basis point on the same, and we should be able to maintain that. On the OpEx, that is the tax, no?
Yes. This one-time settlement that we had done for the sales tax litigations, it's a one-time thing, which was all these cases were pertaining to prior to the GST regime, which we were litigating, and now just since the amnesty schemes are announced by certain state governments, we had opted for it and went in for a settlement, and we don't expect any one-time hit on this count, at least for the next any future quarters. And coming to the bond buyback,
as I mentioned, we did in August 256 million. Which was for two maturities, October 22 and in 2025, bonds which are maturing. This is largely to do with carrying excess liquidity and also the unwind of the hedges what we have for the long-term bonds. If they are in money or not hugely negative, then only we can go in for that. What we have also announced now is another 250 million. For the 23 maturity. So total will be around 500 million is what we look to buy back. And we don't have any plans for further buyback.
Yeah. On the bank part of it, we deny the same because as a company, individually, we have not really discussed with anyone or nor shown any interest in looking at any buying or a merger of a bank. So we don't have any plan on that direction.
Got it. And just a clarification on the yield side, have you taken any price increases on any of your vehicle products and the quantum, if any, there?
Yeah, on the used vehicle, we have increased our lending rates because as and when the liability cost goes up, then typically we pass it on the fresh contract. On existing contract, we cannot change because these are all contractual. But the new lending, we increase by around 25 to 50 basis points, depending upon the segments. normally the smaller ticket, the lending rate increase will be much higher.
Got it. This is helpful. That's all from mine. Thank you and happy Diwali to the entire team.
Thank you.
Thank you. The next question is from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Sir, good morning and season's greetings to you all. I have three questions in the same direction. Number one, does the buying of new vehicles indicate confidence that the economy is going to be doing well? How are the freight rate utilization and freight rates itself behaving? The freight utilization and rates. That's question one. On the bond, sir, can you what is the strategy being buy back the bonds in terms of, the fact that, domestic market liquidity is getting tighter. So, is there some arbitrage that you have that you can utilize? That's the second question. And the third question is on cost. Umesh sir mentioned about inflation. So are you seeing wage cost pressures and do you think that's going to impact cost income later on? That's it from my side, sir.
Yeah, thank you. See, as far as the new vehicle, as I was telling you, customers are getting confidence in the economy or the cash flows. Ultimately, they need a higher cash flow to repay the new vehicle. New vehicle cost will be approximately 2 times of the used vehicle for same application, because application to application things vary. So when they buy a new vehicle, one advantage is it will be maintenance free. That is the advantage. But since the acquisition cost is high, their EMIs will be much bigger. So if the cash flows are bigger, then they repay. So people delay buying new vehicle mainly because of increase in new vehicle value, increase in cost of new vehicle in the last couple of years. First, because of the BS6 technology upgrade, and second, because of the steel price increase. And of course, the third one was chip shortage and supply chain issue. It was mostly to cars, not to trucks. But overall, the cost went up by 25 to 30%. And because of that, many people postponed the upgradation of buying new vehicle plan. Now people are getting confident that since there is very little idling, better freight rate, better movement of vehicle, and also better resale values, they are able to dispose of their existing vehicle at a better value. All this is a positive, and people will definitely move towards buying more new vehicle. And as and when our existing customer buy a new vehicle, we fund them. So that's the strategy, and we are very confident that once they realize that cash flow will be better, and whenever they buy a new vehicle, their repayment also will be equally good. Coming to the bond,
I think we entered the offshore market as when RBI allowed, which was around 5 years back. We are particular that we will continue to tap the offshore market for sure to the extent RBI permits or the limits are available. So whatever support is required, if there is investors in distress looking at opportunity to sell, we want to support the market. What we largely offered was for a very short duration maturity, which was October, and we were carrying excess liquidity. We thought we are buying at par, so whichever investors is keen to sell, we will give them the option. For the long term 25, what we have done was largely because the bond was raised in the current calendar year, January itself. The markets after that went negative. So we wanted to give comfort to the investors, and RBI doesn't permit huge buyback. RBI also is very particular about average maturity to be more than 3 years. So limited option up to 80 million is what we offered to buy back. It was only to help investors, and we are particular that as and when markets are okay, rates are conducive, we will continue to tap the offshore market. So we want to develop this market and give them support, whatever is required.
On the cost front, inflation will definitely push us to increase our wage bill a little. We have done it in this financial year to some extent. But we have not seen big pressure on the overall increase in the cost. So, we estimated the cost increase to 10% in our budget, and that will remain good for the rest of the year.
Thank you very much, sir, and wishing you happy Deepavali in advance.
Thank you. Before we take the next question, a reminder to all the participants. Anyone who wishes to ask a question may press star and 1 on their touch tone now. The next question is from the line of Shweta Daptardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity and congratulations for a healthy quarter. I have 3 questions. The first one being, I understand that your collection team is completely internal, but what is the total collection employee count as a percentage of the overall number?
See, our field team is 16,000 people totally out of 25,000. And there will be another 4,000 people in the supervisory level at branch managers level or collection managers level. So the 16,000 people, they are the field officers who will both source business and collect. We don't have separate team for collection. These people will build relationship with the customer and continue to collect every month. We don't outsource collection to outside. So we don't have any outsourcing arrangement for collection, repossession. Even the repossession is done by in-house team only.
Okay, got it, sir. So you guided for 15% growth for combined entity. Can you guide for the standalone CV financing, Shriram Transport Finance?
Standalone, we had given guidance of 12%, and as for 6 months we have reached 11%, so we should be able to maintain that 12%.
Sure, noted, sir. And my last question, if I look at our liability mix, entities are marginally going higher, have gone higher, securitization a bit down. So where I'm coming from is, I think one of the previous participants.
I'm sorry to interrupt, Ms. Daptardar. We cannot hear you.
Is it better now?
No, ma'am, we cannot hear you. I'm sorry.
I think we understood the question.
Okay, sir.
So,
Yeah, you're talking about circulation transactions being down and bond borrowing being up. Okay, so securitization normally in Q3 and Q4, normally the demand is huge. So that is where we feel we should go beyond the last year what we did. Quantum what we did was 14,000, so we should definitely do more than what we have done in Q1 and Q2. Bonds is something which we, in fact, the bond market for a lesser rated entity is limited, and during COVID time it was completely closed. Now it has opened up, so we want that particular source to be at around 20% of our liability. It was much lower, so it has now reached around 20% level, and that is what we will try to maintain it. And securitization will definitely go up. It is around 15%. I feel by year end it should be around 17%.
Thank you. The next question is from the line of Nidhesh Jain from Investec. Please go ahead.
Good morning, sir. In the current environment, how should we think about margins going forward? I think there is a sequential decline in margins in Q2. How should we think about margins in coming quarters?
The margin we are confident of maintaining it. Q on Q, the margins improved by 7 basis point. So no, 7 basis point. Yeah. So I think we should be able to maintain that. We always guide 7% plus or minus 20. That's the guidance, broad guidance. So that is the target we keep trying to achieve. There will be some movement because of the cost of liability going up and not being able to immediately pass on to entire book, because incrementally only we can increase our lending rate, not to the existing book. So there will be some gap, but otherwise we should be able to maintain around 7.
Sure, sure. And sir, I missed out if you have shared the disbursement number in this quarter, both in terms of new vehicles and used vehicles.
Yeah. We have already given the numbers. I did a new disbursement, 1,020 crores for the this quarter against the previous quarter of 784 crores on new disbursement.
And the used?
Used is 16,502 crores against 15,754 in the previous quarter.
Sure, sir. That's it from my side.
Thank you. Participants who want to ask a question may press star and 1 now. The next question is from the line of Vikash Agarwal from Bank of America Merrill Lynch. Please go ahead.
Hello. Good morning, sir. Can you hear me?
Yeah.
Yes. Sir, thanks for the opportunity and thanks for all the updates. Just a couple of questions from my side. One is following up on the discussion on the NIM just now. Just want to understand a bit more in detail because, the impact, as you said, on the existing portfolio will probably stay longer, and plus the cost of liability is also increasing. I know you are also normalizing the liquidity, but this is 20 bips margin, is that sufficient? 20 bips headroom, is that something which is sufficient in the near term to maintain the margin NIM above 6.8? So that's my first question. And the second question is on the bond buybacks, offshore bond buybacks you're doing. Can you also share what sort of other offshore funding you're using and what the terms and borrowing costs for those funding?
Yeah, see, as far as the net interest margin is concerned, we have a headroom to improve because we have higher liquidity, and we had told in the previous quarter also that we would like to reduce the liquidity portion. Right now we are carrying 6 months of liquidity, which we would like to decrease to 5 and 4 and 3 gradually. So that is where we have an opportunity to and improve the margins. Apart from the increasing the lending rate for the new contracts. Parag, second question.
On the offshore borrowings, we have a combination of bonds. We have loans from banks and also loans from development institutions. Our total offshore debt is close to around 25,000 crores now. And the landed cost depends because some of the facilities are even 10 years, what we have taken from development institutions and ECAs. Bonds typically are 3 to 3.5 years, so hedge cost will be accordingly different. It has been at between 9.5 to 10% in what we have done in the past. But currently what we have borrowing, or what we have taken from development institutions is at around 9%.
9% all in landed cost, including the hedging?
Correct.
Okay. Got it, sir. Thank you. Thank you so much.
Thank you. The next question is from the line of Nilanjan Kafra from Nomura Group. Please go ahead.
Hi, sir. I hope I'm audible.
Yes.
Let's go back to this, offshore bond. So I understand there was excess liquidity, but what tilted the favor in not doing buyback on the domestic and offshore? And I heard Parag, sort of giving, the thing that he mentioned is giving comfort to investors. So which investors are we talking about? Was there some kind of a, stipulation that, something is not right?
No. Nothing of that sort. In fact, largely, if you see what we have bought back is October 22 maturity only. Around 170 odd million, what we have bought back is October. So it was only very, very short duration. And because we were carrying liquidity for excess liquidity from April itself, so instead of carrying that liquidity, we thought we can look at buyback. When it comes to the long term, 2025, what we have bought back is because the secondaries were trading very, very high. Mm-hmm. So we thought we should intervene in case any investor is in distress. In fact, it's only for bonds what we have bought back.
Right.
And offshore we really don't know because it keeps trading to the ultimate owners, we will not know. But secondaries were trading much wider, so we thought we should intervene and give comfort that in case anyone has got any concern, any stresses, we should be able to address it. It's very limited quantum what is permitted as per RBI. That is what we have done. This is only 80 million. So not very, very significant.
Sure.
When it comes to onshore, the secondaries are not trading any wider. So that was there during the COVID period, but post that everything is normalized. So I don't feel any need, any investor is in any kind of distress to sell. So if there is a need, as of now liquidity is there, in case there is a need to support domestic bondholders also, we'll be happy to do it.
Right. Okay. Just a continuation, when we hedge a foreign bond, for example, do we do it on a annualized basis or do we do it for the entire maturity?
We as a policy always do it for the full maturity.
Okay. Fair enough. My second question is to Umesh, I know that we don't have an sort of an outsourced repossession, but if you can talk about in general how the environment is panning out on the repossessed vehicle, and specifically if you want to comment a bit on the Shriram Auto Mall, how the business is doing.
Yeah, see, right now, since the resale values are good, customers would like to hold on to their vehicle. They don't like to vehicle gets repossessed. So that's a tendency. So the repossession increases when vehicle values drop and customer doesn't have the tendency to hold on to their vehicle. The vehicle is an earning asset. And if it's not earning enough and vehicle value drops, then the customer will allow the vehicle get repossessed, or maybe we are forced to repossess because customer is not paying in time. And currently, the repossession is the minimum. I don't think there is any pressure for any of the NBFC industry or even banking industry on the repossession because the resale values are good, earning is good. So repossession has come down. In fact, even in the automobile business, last 2 quarters, we have witnessed that repossession as a source for their business activity has come down. So they are mostly doing the market business now. So market business means anyone who wants to sell the vehicle on their own, they will come on the platform. So automobile is doing good, and the focus is more on the market business rather than the repossessed vehicle from the NBFC or bank.
Okay. So, Vishnu, many NBFCs went into a shell post, this RBI directive on Mahindra. So you don't think something like that is impacting the platform businesses or in general repossessions?
No, that has nothing to do with platform business because repossession, as I believe, most of the NBFCs, they are capable of doing the repossession on their own without depending on outsourced agents. Because the NBFCs which are there for traditionally long time. But if there are new NBFCs which we have just come up in the last few years without enough network and manpower, they may depend on outsourcing agents. And that will be a very insignificant number. So I don't think that will make any change.
Okay. Okay. That's very clear. And a final, small clarification. I mean, the point was also raised earlier. The improvement in the new vehicles, is that something that came towards the quarter end? I mean, just because of the change in festival season, is that what has led to this improvement on YOY basis?
Festival definitely there is opportunity for customers to buy new vehicles. But September end, normally month of September, there will be more new vehicle sales during this Ganesha festival. Then till Dasara, the mood will be upbeat and positive for the people to buy new vehicles. That is normal trend. But what I am seeing is the viability of a new vehicle operation has improved significantly in spite of increase in the vehicle value for even individual operator. And for smaller vehicle, the e-commerce activity and the tier 2, tier 3 town business, the agricultural activity, everything is positive. So people are now buying more new vehicle, and the numbers are visible across the country. 38% increase on year-on-year is significant increase in new vehicle.
Surely, sir. Surely. So therefore, that 15% guidance, you are quite comfortable, right? I mean, we
are comfortable with the 15% guidance for combined entity.
Perfect. That's very helpful, sir. Thank you so much.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal Financial Services. Please go ahead.
Yes, thank you for taking my questions and good morning to all of you. Sir, I had 2 or 3 questions. First one was on the merger. While we just acknowledge that we are comfortable with the 15% kind of guidance on the merged entity, if you can just help us understand that given that the final hearing in NCLT has happened and given that the order is expected in a week's time, what is the operational readiness in terms of working as one combined entity, given that you've been running quite a few pilots across many of your branches? And secondly, from the merger, just wanted to understand how will shares be issued. What I'm trying to understand is, will there be a period where there will be no trading in the stocks of Shriram Transport and Shriram City, or will it be a scenario where there will be no disruption in the trading activity and Shriram City and Shriram Capital shareholders will be issued shares of Shriram Transport, and which will eventually kind of get renamed as Shriram Finance? That was my first question on the merger.
See, as far as the merger is concerned, what we have done is, geographically, we have put geographical head, joint managing directors as the unit head, and they are running both the business, Shriram Transport and Shriram City Union. And even though respective companies keep doing the business, the leadership is in place. And then we had pilots. We had pilots only to understand the challenges of cross-sells of each other products, because the knowledge to be passed on to the staff, training them, reskilling them, and all those things we have done in the pilot 1. Pilot 1 was done in the around 50 branches. Then we scaled it up to 1,200 branches across both the companies. So pilot 1 and pilot 2 is completed. Now the post-merger, it will be for the entire all the branches. So the high ticket lending or high ticket business like SME and heavy commercial vehicle, that is something which we will be doing more centrally. But all other smaller tickets like two-wheeler, gold, and the LCV and tractor, all those things, we should be able to do in all the branches. That's how it has been planned. So the merger will be seamless, and we should be able to scale up the business and achieve the target which has been already guided. As far as the no trading period, There will be no trading period for SCUF, but not for HDFC. That will be maybe 10 to 15 days, depending upon the regulatory requirement. And HDFC shares will be continues to be traded because HDFC will be a surviving company, and that will be renamed as SFL post the completion of ROC formalities.
Understood. This is useful. And so the last question was around, rather two questions. One is, I mean, this new guidance that you gave of 7% plus minus 20 basis points, that kind of stands despite, I mean, the rising rate environment, right?
Yes. I mean, I have given a rationale also that we have a higher liquidity which we can manage and around 7%.
Understood, sir. And so lastly, on this reposition ban which was recently there by the RBI, while you have clarified that Shriram Transport has no engagements with third-party agencies for collections and repositions, just wanted to understand, as an industry, has RBI engaged with you in the past or after this recent ban and advised to improve, I mean, some of the reposition processes? Wanted to understand if the regulator is a little concerned with the industry as a whole when it comes to repossession processes, or was it an isolated incident for a particular vehicle financial?
No, see, basically in the past also, on the collection part of it, and the harassment of the borrower is part of it, RBI did had interaction with us. But this incident is isolated one. It is nothing to do with the initial discussion we had with the RBI. RBI wants us to have a proper standards on engaging outsourcing team and methods of either reposition or collection to be properly guided, and the proper manual being there, and training to be given, even if it is outsourced. All those things are there. It is more of a discussion. And we also had, as a FIDC, we had come out with broad guidelines on reposition, and handbook was released long back. And once again, after this particular incident, it is an isolated an unfortunate incident. Once again, we have given our broad outlook and broad guidelines on the same, and that is shared with RBI, and also seeking the appointment with RBI to further improve, if necessary, on the same. So, as an industry body, we are working on the same. But there will be always some kind of some incidents which can go out of control.
Thank you so much, sir. This is very, very useful, and wish you and your team all the very best, and look forward to speaking to you next quarter as a merged entity. Thank you so much.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Hi. Thanks for taking my question. Just a couple of points. What is the target, gross stage 2? You've come down in single digits. So where do you think, this kind of goes in and settles down? Or what was the level before COVID where you think it can go to?
Stage 2 would remain range bound in between 10 to 12%, and I think we have significantly improved over the last 3 to 4 years. Once we have moved to the 90 days, right from that day, it has been a continuous effort to bring it down, because when we moved from 180 days to 90 days, it was a gradual improvement. Customer had a little bigger time for managing his NPA, and we have been educating the customer. So over the period, we have brought it down, and we should remain at this level. I don't think it will significantly improve over it. Since most of our lending is asset-backed, we need not really get disturbed or perturbed with this, and we are feeling that this is a good comfortable range.
What is the current IRR range, as an interest rate range that you are charging for used series and new series?
Used
CV and new commercial vehicles, what is the...
Used CVs, it ranges between anywhere between 14 to 18. It all depends upon the vintage of the vehicle and also ticket size. So the simple principle, higher the vintage, lower the ticket size, higher the rate.
So I mean, just a broad range for the used versus new, how much would be the weighted average differential?
Weighted average differential between new and used will be around 300 basis point.
Sure. And just the last one is, on the, possible use on the liability side after the merger. Currently, now we are kind of very close to the merger, and I guess you would have evaluated the, consolidated borrowing position. So what could be the, juice left out there, probably borrowing, repaying some of the, high cost borrowings on the consolidated level and, probably accessing cheaper ones or maybe, kind of just as the more expensive ones get redeemed, replacing it with a cheaper one, or probably, looking at a consolidated liquidity position. So very roughly, some assessment on your side in terms of what you would have done and what could be the benefit.
See, this is a continuous work, and I think Parag will be able to explain it better.
Yeah, in fact, if you look at Shriram City Union, because you would have been looking at it very regularly, so it is more skewed towards fixed deposit, retail deposit, and bank borrowing. So there is not much of bonds. Offshore is anyway not there. So it is, look at the total borrowing what they have from banks. I don't think that adds very significantly to the overall bank borrowing. So it should continue to add around 20-21% of our liability post merger. And looking at whether we can reduce cost, I don't think we will force that. And we will only look at borrowing fresh from the same banks at a lower rate. We will not go in for immediately paying off. When it comes to the overall liquidity, what we'll maintain, I think the policy will remain the same. 3 months of liability repayment to be in hard cash for the merged entity also is what we will look at. We did mention that around 11 to 12,000 crore is what is required for Shriram Transport. If we add Shriram City Union liabilities also, it should be at around 14 to 15,000 crores of overall liquidity to be maintained. That is what we will do post-merger.
And if I have to look at, let's say, facilities from the same bank, is there a differential between what you are able to borrow and what they borrow?
Yeah, definitely. There is a differential. One, there's a rating difference itself. Banks also have been pricing it differently. Capital market automatically goes by the rating in the public domain, but banks also, there are rate differentials.
But then that's something that you kind of get negotiated immediately?
Correct. So immediately, I don't think banks will immediately reduce the rate, but whatever fresh we borrow from the bank will definitely be at a much lower level.
Got it. Thanks. Those were my questions. All the best and happy Diwali.
Happy Diwali.
Thank you. The next question is from the line of Ajit Kumar from Goldman Sachs. Please go ahead.
Thank you for taking my question. So first, on the OpEx side, despite increasing employee count by more than 1,000 in this quarter, why is employee expense down sequentially? And how do you look at employee and branch addition going forward as disbursement picks up and impact on the cost to income ratio side? That is one.
You wanted a clarification on the cost going down? Employee
cost right.
Okay. See, in the first quarter, we typically pay the annual incentive for certain grade of people, and hence it was on the higher side. And current quarter, it was not there, and hence it was lower compared to the previous quarter.
And as far as the employee count, see, we had not recruited more people in the last 2 years. during the COVID years, our recruitment drive had come down. And actually, our employee count also had come down. From around 27,000 employees, it had come down to less than 25,000 in the last 2.5 years, because we did not do fresh recruitment, which we started doing in the last 6 months. So therefore, the number of count is going up. And for our business, as we increase the volume, we do need to add a more number of people. As far as the branch is concerned, we have not opened any branches in the last quarter. We did not add any branch. Going forward, since post-merger, then we will look at this scope and opportunity to open more branch or using the existing network of combined entity. So that we need to really work on. We already have a blueprint on the same, but we'll execute it over the period.
Okay. Thank you. And second, coming back again on the liability side, what could be the mix going forward? Or in other words, on which funding instruments you will focus more on? And how much increase in cost of fund do you expect in next 12 months or so?
The funding mix, whatever is there for Shriram Transport, that is equally distributed between deposit, offshore, bonds, securitization. 20% each is what we will look at for the merged entity also. Borrowing cost, as of now, for the next quarter, I can definitely say it will go up around anywhere between 8 to 10 basis points. Going forward depends upon how much further rate increase is there. So that kind of increase will be there. But banks have increased rates in line with, or the capital market rates also have gone up in line with the repo rate increase. So we'll have to only look at the policy rate hikes and then factor in what will be the cost side for us. It will be in line with whatever is available in the market. But 8 to 10 basis points is what I can tell about the next quarter.
Okay. Thank you. Thanks a lot.
Thank you. The next question is from the line of Chandra from Fidelity Investments. Please go ahead.
Hi. In the last quarter, we used 200 crores of our buffer provisions. We've used about 100 crores of our buffer provisions in this quarter towards write-offs. We still have 1,700 crores of buffer provisions. And my understanding is that the contracts for which we have made these provisions should be maturing before the year end, given the tenure of your book. So how are you thinking on what would eventually happen, given sequentially the utilization also has come off?
These accounts will get matured over the next 2 years, because typically average contract would be 4 years. And over the 2 years, it will get adjusted. So we have now, last 2 quarters, you have seen the trend, and we have 1,700 crores. So we expect maybe another 500 to 600 crores by this year end. Then maybe the rest will be next financial year.
Sorry, my understanding was some of this was created because of the moratorium interest period. And my understanding earlier, I think I've always said that contracts should mature by the end of FY23 for these. So you'll take a decision on writing back after then. It seems that you have a different thought process now.
No. See, all these contracts were pre-COVID, which were sold prior to March 2020. And for all these customers, maximum of the customers, we had extended the moratorium approved by the government. And these cases typically will have a tenor of 3 to 4 years. And the majority of the cases will come to an end by the end of this financial year, and something will be spilled over to the next financial year. That's what he was trying to indicate.
Understood. So you don't really expect any write-backs at all from this?
Write-back is very difficult, because in the segment of customers that we cater to, they come in for some waivers at the end of the contract, and these 6 months during the COVID period, they had all been impacted, and we had assessed that thing and had created this provision. And we believe that it will go out as a waiver and not much should come back as an write back into our books.
Sure. Then just a couple of questions there is a stamp duty of, if I'm not wrong, about 200-250 crores. I would presume that in this quarter we should see that impact in the P&L number.
No.
And second is that, when the merger was announced, there was about 68 crores of employee cost rationalization which had to be done across to sort of equalize wages. I would presume provisions for that also would be taken in the third quarter.
The stamp duty will not be as high as 200 crores. We had initially anticipated that the maximum amount that was prevailing in Tamil Nadu was around 200 crores, but I believe there has been some relaxation as far as that is concerned, and the amount involved will be much lower than that. And coming to the cost rationalization, we are still working on it, and it will take the next 2 to 3 quarters for that to really impact. But we don't expect that to come in the next quarter immediately.
Thank you.
Thank you. The next question is from the line of Amit Jain from Axis Capital. Please go ahead.
Yeah, hi sir. Good morning and thanks for taking my question. Sir, in this quarter, the credit costs have come off as compared to Q1. So just wanted to know your outlook for FY23. How are you looking at credit costs? I believe they would be on a declining trend, but just wanted to know your thoughts on that.
Yeah, we have given a guidance of 2% as the credit cost for the full year. We should be close to that.
Right, sir. And in terms of sir, excess liquidity, what is excess liquidity currently on the balance sheet, sir?
Around 5,000 crore is what we have excess. With one large maturity this month itself, we should be able to utilize that. So around 5,000 to 6,000 crore is what is their excess.
Right, sir. Thank you, sir. Thank you so much.
Thank you. There is a follow-up question from the line of Rikin Shah from Credit Suisse. Please go ahead.
Thanks. My question has been answered.
Thank you. The next question is from the line of KC Puvanna, from an individual investor. Please go ahead.
Hello.
Hello, yeah.
Hello. Am I audible?
Yes, yes.
Good morning, everybody. I'm a shareholder. As such, you can expect my question easily. The question is to Mr. Umesh. Last year in the September quarter meeting, you had declared an interim dividend of 80%. This time there's no such declaration. Why is that? Hello?
We will plan something in next 2 quarters. This quarter we have, because of the merger, we thought it is better prudent to do it post the merger from the Shriram Finance. That is the plan.
That means we can expect any dividend only after the merger is completed, is that?
Yeah, merger will be completed in this month, that's November month. So next quarter you can expect, next 2 quarters.
Okay. Thank you, Mr. Umesh. Thank you very much.
Thank you. Ladies and gentlemen, as that was the last question for today, I would now like to hand the conference over to Mr. Umesh Revankar, Vice Chairman and Managing Director, for closing comments.
Thank you all for joining this call. Let me first wish you a happy Diwali, and let us have this festival as a revival of Indian economy and being a leading economy in the world by growing the fastest. And that should augur well for us, and I expect next couple of quarters to be a much better quarter than this quarter, as demand, collection and customer business, everything is looking very sound and good. Thank you. Hope to see you all in the next quarter call. Thank you.
Thank you. On behalf of Shriram Transport Finance, that concludes this conference call. Thank you for joining us, and you may now disconnect your line.